Reading price charts, bar by bar. The technical analysis of price action for the serious trader. Chapter 9, minor reversals, failures. Table of contents. Failed signals and entry bars and one tick failed breakouts. Failed high 2, low 2. Failed higher high and lower low breakouts. Failed trend lines and trend channel lines. Failed reversals. Failed final flags, tight trading range. Failed final flags, huge bear trend. Failed wedges. Failed scalps, 5-tick failed breakouts, and failure to reach a scalper's profit. Failed signals and entry bars and 1-tick failed breakouts. 1-tick failures trap eager traders into the wrong side of the trend. It's easy to get trapped in a tight trading range. Traders should wait for a clear breakout before entering. When the market trades 1-tick higher and reverses, this can make for a good scalp. Bulls will hit out of their failed breakout trade while bears short for a scalp. So here we see a downtrend and then an uptrend. This uptrend stops at the previous swing high, and it looks like a bull channel. However, it's a test, and the bears sell, and we get a new low of the day. Bulls will buy the flag here, and they get trapped and have to hit out. This is also the tight trading range. Failed signals, bear to bull. So here we have the bear trend, leg 1, pull back, leg 2, pull back, leg 3. Bears may say this is a breakout below the EMA, however it's bad follow through, and this is a range bar. So this is where they would get trapped and the market reverses, testing the prior extreme. Failed high and low 2s. High 2s and low 2s are a reliable trade to take. When they fail, it's possible the market has entered a channel in the opposite direction. If the high or low 2 fails, there possibly could be 2 or more legs in the direction of the trend. Wait for a high or low 4. If the high or low 4 fails, the market could be in a small pullback trend. Only take with trend entries. Here we have a failed high 2. It's a bear leg, a bearish breakout. First pullback creates a high 1. Second pullback creates a high 2. This high 2 is a trap because it comes at a worse price under the EMA. The bulls get trapped and we make another leg lower. Here's your high 3, another leg lower, and a high 4. Here, if you buy this long, you have to buy more lower, but we've been under the EMA for a very long time, so we could be in a bear trend. It's better to just wait. Here is a bull trend. You have a bull leg, a pullback into the EMA, and a low 1, another bull leg, and a low 2. Bears that get short here are trapped, and that creates another leg higher for the bulls. Here's a low 3 and a low 4. You might be able to hold this for a quick scalp, but ultimately the bulls got another leg higher and a breakout the next day. Failed higher high and lower low breakouts. Most days the market is range bound. This is a good setup to fade new highs and lows. However, traders should wait for a clear trendline break. If trading before a trendline break, it is possible to be fading trend. This will result in a loss. Failed higher highs. Here we have a strong bull trend with a leg 1, pullback leg 2, pullback leg 3. This bear leg breaks the trend line. And then bulls go for a retest, and you can start to fade. Here you can see this high is a good fade. You can fade this for a second leg, fade that for a scalp, and fading here would be a decent swing lower. Failed lower lows. Here we have a strong bear trend. Leg 1, pullback leg 2, pullback leg 3, and the leg 4 breaks the trend line and retests the lows. After the trend line gets retested, you can start buying bear candles for scalps, and it works. You buy this low, buy this low, you buy this low. You can buy this low, buy more lower, get out here. You can buy this low, buy this low, you can buy this low because it shows bear pressure, and catch them. You'd have to scalp. It's a broad bull channel. Failed trend lines and trend channel lines. Trend lines should contain the prior price action. When the trend line breaks, this is an indication a reversal is on its way. This doesn't mean position for the first break. Often the market will retest the prior extreme before reversing. Failed trend lines and trend channel lines bullish. Here we have a bull leg and a deep pullback. These candles show that there's bullish pressure stepping up, and this candle shows a bull leg testing the EMA. Bears get another leg lower, and this creates a double bottom. This is the retest where you can start to buy and go for bull legs that lead to a couple hours of sideways to up trading. Failed trend lines and trend channel lines bearish. So here we have the bull leg and then a double top. This double top shows the retest, and it's also a lower high. After the double top is here, bulls will get trapped. They buy more, they come out. Bulls hit out here, bears get short at the previous swing high, and that creates enough pressure for a few legs lower. Failed reversals. No matter how good a pattern looks, it can fail. This is an opportunity for smart traders to scalp where weak traders put their stop. Nimble traders will place a stop order exactly where weak hands will place their protective stop and go for a scalp. Failed reversals, bullish scalp. Here we have a gap down with 3 legs lower. Weak hands will short here, thinking this will be the start to a bear trend that lasts all day. Bulls know stop orders are laced around here, and that's where they're going to put their long scalp. They put their buy stop order where bear protective stops are at and go for a long scalp. Failed reversals, bear scalp. Bears see this strong leg down and the market is in a tight trading range. Bulls see a breakout above the EMA and want to go for a test of the highs. Here's a leg 1, pull back leg 2, pull back leg 3. That's a wedge top. Weak bulls will buy this high, and strong bulls will put a stop down here, knowing the market should test the EMA soon. There's a lot of selling pressure, and this is the wedge top. Smart bears make a scalp for 1 point. Failed final flags, tight trading range. Often the market will form a tight trading range late in the trend. A key point is final flags will often be horizontal. A horizontal area is a form of two-sided trading. Final flags can start to reverse for 2 legs. This gives the trader an opportunity to take a reversal and make a profit. Failed final flags, tight trading range, bearish. Here we have a leg 1, pull back leg 2, pull back leg 3. At the bottom of a wedge, the market goes horizontal and it's a tight trading range. Bulls get a few legs higher. Failed final flags, tight trading range, bullish. Here we see the bulls have a leg 1, pull back leg 2, pull back leg 3. The nested wedge right here. Bears break the trend line and we go into a TTR. Bulls go for the breakout and it fails. This leads to a few swings lower for the bears. Failed final flags, huge bear trend. Final flags can only be 1 to 2 bars long. They will happen quick. The bars will be unusually large, and when they fail, it could lead to a couple hours of trading in the opposite direction. This is a counter trend setup, not a with trend entry. The market can travel to the extreme and reverse. Failed final flags, huge bear trend. Here we see a lot of sideways trading, but the EMA is acting more as resistance. Bears get the breakout with a leg 1, pull back leg 2, pull back leg 3. The leg 3 is hidden, but we can see a lot of bullish pressure picking up. Bulls will buy this low, and they get the reversal that leads to a couple hours of trading. They reach the previous swing high. Failed wedges. New traders will look for wedges in bull trend and bear trends. They will often take a loss because they are eager to catch a move rather than waiting for a trendline break. When 3 pushes happen, this forms a wedge. However, when the pushes are small, they will rarely reverse. Traders should look to take a with trend entry until there's a trendline break, then look for a wedge or reversal pattern. Weak traders will get trapped into looking for reversals. They will add to the fuel for the with trend traders. Failed wedges, wedge top. There's a lot of wedges here, but I just outlined this wedge and this wedge. We have another wedge top here and a nested wedge right here. If you were to take a short on any of these wedges, you would either have to scalp out very fast or you would get trapped. At the end of the 3 large legs, leg 1, pull back leg 2, pull back leg 3, we get a trendline break with this bearish leg here. Bulls go for a retest and you can start to short new highs. This was a good scalp. Failed wedges, wedge bottom. Here we have a push 1, 2, and 3. We have another wedge bottom here and a very steep wedge bottom here. If you were to buy any of these, you'd have to scalp out very fast or you would be trapped. When you hit out of your long, you add to the selling pressure. Bulls get the trendline break here, and you can see how buying the dip ultimately led to a bullish breakout. Failed scalps, 5 tick failed breakouts and failures to reach a scalper's profit. A scalp in the E-mini is 4 ticks. When a trader places a limit order to exit and the market travels to their entry but won't fill them, this is a sign of losing momentum, trapping traders out of a winning trade. Failed scalps. 5 tick failed breakouts and failures to reach a scalper's profit. Here we have a bear leg, and traders may think we can go for a leg lower here. This is two-sided trading, and they're actually short and range lows. Bears that go for a point here make 1 point, but since it doesn't travel 5 ticks, it doesn't fill them and it fails. Here we can see a bull trend. Bulls may see this as a leg 1, pull back leg 2, and go for a continuation. Bulls that buy this high will set a limit order for 1 point higher. For them to get filled, the market has to travel 5 ticks, pass their limit order, and turn around. The market only traveled 1 point, trapping them out of a winning trade. They have to hit out and the market dumps. This is the end of chapter 9. Please leave any questions in the comments and I will try my best to answer them. Thank you for your time.